Afternoon, everybody. Yeah, again. Today's Tuesday, the 26th of October. And we're having the last lunch hour, FM lunch hour for the month of October. We're also going to be using today to conclude on our asset management series. From next week, it's all going to be workplace productivity. From the month of November through to December, we're going to have 8 sessions of workplace productivity discussions, and I hope you'll stay tuned. There are 2 aspects of your life that determines your progress in your career and your business. One is the aptitudes, the skills, competencies, knowledge, abilities that you have to execute the task that you have before you. And the other is your attitude. And the attitude is more of the soft skills, the personality, the character, the habits parts that forms your personality, that forms who you are, how you are perceived, how you perceive others. So far in the lunch hour, we've been dealing with all of those aptitude topics: strategy planning, maintenance, asset management, and so on and so forth. So we're going to launch into the attitude series, which we call the workplace productivity series. So straddling for sessions on emotional intelligence, leadership, supervision skills, coordination, all kinds of skills that that bring you out, that bring your best side of you out, and actually helps you to win big in the work environment and your life generally. The sessions that are going to be following today are more generalist in nature. Your accountants will be interested, your engineers and lawyers will be interested, your wife and husband, your spouses will be interested, the children will be interested. So I expect us to blow this workplace productivity series far and wide and get as many people into the sessions as possible, because those are the series we're going to be talking about life generally. Okay. So today, as promised, we're going to be looking at financial management. And I'll basically just be talking about certain key areas of how our assets can be impacted by how we plan our finances, how we execute. Okay. And the kind of considerations in facility management for assets. Sharing my slides. Okay. As a background, every asset is an investment. Somebody spent money on it. Okay. And your job as a facility manager is to not just use it, operate it, but also to preserve, increase its value, reinvest in it on an ongoing basis as part of that, preservation and value increment approach to its sustenance. Okay, so that's why I want us to really just pay attention to this one, because if you don't talk about money when you're talking about facility management, then you're really not talking professionally. You're really not adding value. Money creates everything, and we can't be seen to be wasting money, making decisions that are counterintuitive with regards to how money is acquired and spent. So today I'm going to be talking about concepts like life cycle, total cost of ownership, facility condition index, budgeting. We'll talk a little bit about budgeting and on how to plan effectively for finances that we spend in our facilities that we manage. Okay. Okay, and before I dive right into it, I just like to announce again, remind you all that the FM Diploma starting in January still has the lock in the old rate offer till the 30th of November. I want you to prepare for a 2-day session of free training in December. We want to take facility management to the assistants crop, the people that you work with at the shop floor. So get your cleaners, technicians, handymen, porters, receptionists, and all of those ready for an introduction to facility management day one. If people are working for you in your organization and you're able to show them possible paths to progress and becoming you in the future, they will be more motivated. So we're trying to use that training to bring those who never thought of themselves as facility managers to start thinking about how to do their work differently, the skills they need to acquire to upskill and move up the ladder. And in day 2, we're going to be having a focus on workplace productivity, but it's going to be specially focused on practical tips and tools you can implement right now to boost your career. So it's going to be a career boosting event for people in the built environment. So those are the programs we're setting up for you in December. More information will get to you. The planning committee puts together the details of the schedules, time, and topics. We'll get those to you via emails, and please stay in tune, stay connected with us on our social media platforms. All right, so in today's launch, I'll be starting with a few guidelines for FM financial operations. When managing facilities and assets, you must start by having a clear understanding of the organization's mission. Why do we exist? So this links you back to the big picture framework I shared with you some weeks ago, the strategic objective of the organization. Every time you make budgetary decisions regarding where to put money, what activities to invest in, what to engage in managing your facilities, you're actually going to commit the organization to some spending, right? Are you going to be spending in line with the mission or purpose of the organization, or at variance with it? So we need to have that understanding first. We also need to know that within an organization, we are in the FMS department or business units, we tend to see a lot of relevance with our work. We see how important our work is. We know that we are the oil that oils the wheels of the organization to get everybody rolling and doing their thing and providing results. But sometimes we overestimate our value when we begin to get in conflict with members of the C-suite management. We begin to be in having a different mindset from our management, and also certain business units that are key to the survival of the organization, like the finance team, right? So having a good relationship with your finance team will help you out in your facility management career, especially with regards to how facility spend is prioritized. Okay, if you don't have an understanding with them on where the organization is going, you may be making requests that they will not grant. If you do understand the big picture and you cannot relate with them to communicate that vision with them and show them that alignment, their own priorities will be away from your priorities. And if that happens, the finance team's priority is going to be superior to your priorities in the eyes of management. But having that rapport, that a good relationship can lead to, a favorable response to your requests for funding to deal with issues. Organizations will also have accounting practices, policies, that you as an FM must learn and imbibe. I always tell facility managers, don't try to seek exceptions. Don't say, oh, what we're doing is so important. If we don't do it, nobody will work. Therefore, I don't need to go through all that paperwork and all that processes. No, 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 no. The moment you try to seek exception from controls and processes in the organization, you label yourself as a criminal in the organization. You get funds to spend on things. You're supposed to learn the chart of account codes for the various spending categories. Learn them. Don't retire and say, oh, I'm not an accountant. No, learn what specific accounting you need to understand to give transparent account of how you spend the organization's money, right? And the same thing applies to budgets. Learn how to properly charge budget line items to the various codes so that you will be in compliance. Maintain clear, well understood, and documented financial handling processes. It's very important to know what the rules are and follow the rules. Keep accurate financial records. Every spend was spent towards a particular asset, was spent at a particular time for a particular purpose related to that asset. All this information needs to be cataloged so that if a time comes for us to decide, take a decision around, should we spend more, should we get rid of the asset, you know what to query. You have an accurate financial record. You have data to back whatever position you want to take regarding actions you want to propose to management on asset acquisition, maintenance, and operations. Compile accurate historical data for evaluating trends and forecasting. You can be managing facilities from day to day, month to month, year to year without having accurate historical data on how much you're spending disaggregated to what I just analyzed. Okay. Your budgets, you've set a budget, it's been approved, you're spending your budget, other departments are helping you out in your spending through, for example, procurement, helping you to get vendors and bid out jobs and the rest. But you need to know where you are on every line item in your budget at any particular time. So it's not enough to say, I know that, oh, this is October 26th and I have X amount left in my aggregate budget. No, you need to know how you're performing with every line item in your budget, because there are some things that will require you to slow down because you probably will run out. That chance you might make that will make you to spend too early for some activities, and you may have to slow down. There are some activities that are so critical that you may need to. I mean, it's not yet due, maybe due in November, but the funds you have on that line item is not going to be adequate. You need a process to apply for budget environment changes, budget reallocation and realignment, whatever you call it in your organization. Start, because you're focusing on how your budget is performing and on a month-to-month basis, you're able to make that application now, not when you need it. It's when you're not beginning to say, oh, let's move the money from here to here in my budget. Don't forget that you're not the only one probably looking at your budget. Some other departments, senior management are also looking at the budget and saying, oh, I don't think you will need that money again, so let's move it out somewhere else. So if you think there's another place where you might need it as the operator of that budget, you should have acted proactively. All right. So both your budget should be spent in a balanced way, not underspent, not overspent, both aggregate and on the line item basis. And then know how to discern the managerial implications of external and internal financial statements. FMs needs to understand finance, needs to understand basic accounting. So when your organization's audited account is published, if it's a public company, or it's the management is working through budget with different departments, understand the implication of certain decisions. If we say we can't do something because we don't have the money, or because we have priorities for something else, it will give you an indication of where we are going as an organization, and help you make decisions next time you have to make decisions. Okay, so let's get into the specific asset management, financial skills that you must have as a facility manager. The first is a skill to understand and apply life cycle costing for all decisions. All right. We make decisions between all kinds of options every time. Most of the time, our decisions are based on the obvious cost that we can relate with at the moment. That can become a problem. Okay, because the cost of acquiring, the cost of operating, maintaining, repairing, and disposal, they all have to be borne for every decision we make. So don't make decisions based on the obvious beginning cost, which is the acquisition cost. No, you need to do a life cycle cost analysis of all the options where you are comparing every cost related to the life cycle stages the assets will go through. So an equipment, for example, that's going to last useful life of 7 years, and another equipment that's going to have a useful life of 15 years, means that if you are doing the life cycle analysis for the 7 years one, you are accounting for its acquisition twice, its disposal twice in a 15-year period, because they're going to compare it to another asset that's going to run for 15 or 14 years in consideration, right? And then life cycle cost analysis also requires you to understand what we call the time value of money, where you have considerations for making a decision today based on today's value of all future expenses. Okay, so a typical example is you have to choose between two air conditioning types. They're both 2 horsepower. The starting cost for one is 200,000 and the other one is 300,000. What you shouldn't do is say the 200,000 one is cheaper, let's go for that. That means you're not having a life cycle consideration. Okay, so don't go for that. Now, what else goes into running an air conditioner? You have installation costs, which includes kits and labor. You have maintenance and ongoing maintenance costs. You have the repairs and spares costs that will go into, taking care of reactive and planned repairs in the process. And you have an operations cost, which includes the energy consumption before you now deal with the disposal costs. How much will it cost you, if any, to take it out and dispose it, or is there any revenue coming from its disposal in terms of salvage value, right? So you put all of those in a chart. So you have item A, 200,000 starting cost, item B, 300,000 starting cost, and the next line item is operations. So what goes into the energy consumption? If I have to have somebody on standby, in the case of some elevators that you have elevator operators, for example, compared to elevator that does not need elevator operator, you add up all of those operations costs, mainly manpower and energy, which are the main aspect of operations. And then you put those in. And then you bring in the maintenance, the routine maintenance. You put them in, the reactive or repairs estimates for them. You put those in, and then you have the salvage value or disposal cost, whatever the situation will be for each of the assets. How do you arrive at the amounts you are comparing? Because at the end, it is the total that will now tell you, not the first cost. That total that tells you, oh, this one life cycle, 4 years time is 830. The other one is 890, for example. So I won't go for the one of 890. I'll go for the one of 830. Now, the one of 830 might have been 200,000, might have been 300,000 or 200,000, whatever the starting cost. I ignore the starting cost because I'm not using the bottom line consideration. But how do I determine the cost that goes into each of those line items for operational maintenance, repairs, and the rest? I plot the cost the way it should be into the various years when those costs will be due, right? And I convert those amounts to their future value or net present value. So let me use the inverse. So if I'm going to spend 100,000 next year for energy for that air conditioner, for example, how much do I need to put aside now to earn 100,000 next year? If I'm dealing with an interest rate of 10%, that would be 90,000. So 90,000 today will give me 100,000 next year. So even though I'm going to spend 100,000 next year, the line item for energy consumption for next year on my life cycle cost analysis is going to be 90,000, right? Because I'm trying to get a total that is today's outlay for the life cycle of that asset. Doesn't mean I'm going to put out the physical cash for the life cycle of the asset, but I must make sure that I have that understanding upfront. So let's have that basic understanding. When doing analysis, sometimes you might ask you, why did you go for this? Why didn't you go for that? You don't have valid, premise for a decision beyond the first cost, and that may make you look very unprofessional if you're not doing the life cycle cost analysis. The other one is total cost of ownership. Think about total cost of ownership as looking at life cycle costs, but this time you are having purely monetary consideration. Something else I didn't mention during life cycle cost analysis is there are other factors that you can use to make decisions with life cycle cost analysis. I've done all the costs, which the analysis I did before was really total cost of ownership, right? What we call cradle to grave costs that will go into it. But then in doing life cycle cost analysis, I'm also looking at other considerations, sustainability considerations. I'm looking at human considerations like aesthetics, convenience of the users, strategic direction or preference of the owners and the rest. But in TCO, I'm dealing purely monetary. I'm taking everything that I want to consider and I'm converting them into monetary consideration. So I use TCO as an input into my life cycle cost analysis. But it's important to know what your total cost of ownership is for every of your assets. Now, the next item I want us to look at is the opportunity and cost of changes stroke error correction at different phases of the asset development life cycle. Every asset you deploy will go from design, of course, from planning to design, construction, procurement, all of those procurement, construction, operations and maintenance and so on. It moves in that, cradle to grave set of phases. Now, you need to think about this as every time as you are moving on this life cycle phases of your assets, your cost saving opportunities for every decision or every phase is reducing. At the same time, the opportunity cost of error correction is increasing. So these are two graphs that works in opposite direction. So let me take the cost saving opportunities that is reducing. While I'm designing, I'm working with my team and we're contemplating whether to install louvered windows or double glazed gas filled thermal windows. And we discuss back and forth about the implications. If I decided while we are still doing design and sketches to just use plain 3mm, 4mm thick window panes that will not provide thermal insulation for the building. And later I realized that, the energy consumption is very high, energy cost is very high. I can't afford this level of energy consumption. I need to now look at my, thermal insulation. I probably would say, okay, let me put a dark film over, on the windows from outside. So a reflective dark film, on the windows to reduce thermal ingress. I could decide to build some hoods over the windows, use more window blinds, darker ones to reduce the impact of sun and heat in the facility. Now, all of these things I just mentioned are costs that I'm going to spend to get them, right? Because I just realized that my cost saving opportunity has dwindled. Because if I wanted to make those changes while it was still on paper, very easy, very cheap. By the time I've done the window frames, not so cheap anymore. By the time I've finished the building, the windows are already in place and we're not using it, and I'm not coming to the reality of what's going on, my cost saving opportunity has dwindled to the least because I'm now seeing that my energy cost is high due to building fabric, poor thermal insulation, right? And then to the other graph, the opportunity cost of error correction. If I were to fix those errors on paper while they're still sketches, it's just designer's time, right? The man hours of the architect. If I were to fix them while the quantity surveyors are still working on the bill of quantities, piece of cake. But when I'm going to fix that error and start saving that energy, to reduce that energy wastage later using the films, using window blinds, and using hoods over the windows, the opportunity cost of error correction is just going up. Okay, you might have experienced this when you are trying to fix issues with new buildings, plumbing not doing the right thing, leaking or blocked here and there, and you're breaking walls, right? Or you do pressure testing and realize that leakage everywhere because you use a PVC pipe piping system that the work method wasn't very good or whatever it is, and you're having all these leakages. You have to open everywhere up and start fixing. You spend a lot more in doing that than when you would have just looked at the design and the bill of quantities and say, you know what, why don't we use multi-layered pipes? Why don't we use continuous piping? Why don't we change these PVC pipes? I mean, it's going to cost you extra if you look at the bill of quantities for switching from this simple cheap piping to a more but overall it's going to save you from that higher opportunity cost of error correction. We don't want to be correcting errors. We want to be looking at the implications for our decisions from the moment where we're taking those decisions, so that we're not caught unawares whenever we're taking financial decisions. This is kind of thing that can also help you in this particular model, can actually help you in convincing your management, about certain decisions. If you're involved in a construction project and certain decisions that are going to come back to cost you a lot more over the next 10, 15, 20 years you'll be managing that facility, it's important that you can model that cost, right? Using the time value of money principles to add up all of those costs, showing the difference between option A versus B. Now that we are still in design and early stages of construction, compared to what it would be when we are managing the facilities in those years. So if you can add up all of those using time value of money principles, you can come back to management and say, oh, we have a choice between increasing our plumbing costs from 7 million to 9 million, for example, to switch a particular piping specification, which is a 2 million increment. Looks like a lot of increment right now, but I've modeled the maintenance implication, the operational implication of using the cheaper one over the next 15, 20 years. And I can tell you that we have a 20 million bill difference to incur if we don't spend this 2 million now, right? That's kind of data, that kind of analysis gets management to think again and say, you know what, let's go for the other piping system instead of this cheap one that's going to save us 2 million now and expose us to 20 million, especially when you can talk about the future exposure, not just in terms of total cost of ownership, but in terms of life cycle. What all the other things that comes from customer dissatisfaction, not being able to sell property, issues with contractual obligations, complying with contractual obligations with clients, and all of those complications that can become an entanglement for the organization into the future that can create bad reputation and so on and so forth for the organization. So you itemize all of those and you bring that forward now that the construction is still starting. All right, so the next financial concept for asset management is ask yourself, do I have to buy the assets? Have you considered other alternatives of how you can get the utility you desire? Because for many organizations, in fact, for most organizations we serve as facility managers, they don't necessarily need to own facility-related assets. Okay? You don't necessarily need to own pumps and transformers and generators. It's not relevant to the core business. The core business has certain utilities it needs. We need comfortable environment, which is cool and filtered air. We need electricity to run to all workstations and power our devices so that we can get the core business done. We need water flowing so it can be convenient. We can be able to get water to drink. We should be able to get use the toilets and not worry about our health around those environments. Those are the utilities you're looking for. If your mind is always focused on, to get those utilities, I must acquire an asset, a physical asset, and we must own it, then you'll be making a big mistake. And this is one thing that has, hindered the career progress of many FMs. What alternatives do you know out there? There are organizations right now providing leases for all kinds of assets. All kinds of assets. Rental services exist. Some provide the utility as a service. I mean, there's a difference between, I don't want to buy the generator. Of course, we'll talk about the implications of why we want to buy versus why we don't want to buy, right? But if I don't want to buy and I want to use somebody else's generators, I can rent the generator. In that case, I will operate it and maintain it, and I'll pay for the period I'm in custody of that generator. But I could also use, have power as a utility, power as a service from the generator owner. So he's not renting his generator, he's holding on to his generator, but then he generates power using that generator for me. And while I don't care how he generates it, I'm not having any business with the generator, I pay for just the energy that I consume from his power production, right? So there are always three ways for everything, whether it's copiers, refrigeration, air conditioning, electricity, generation, and so on and so forth. There are always these, I can buy mine or build mine, I can rent or lease, or I can receive utility on a pay-as-you-go basis. What drives those kind of decisions? Because sometimes you want to make recommendations to management that will support the management's position, that will be in line with the management's vision, that will be in line with the current reality of the organization that you are managing. Some influencing factors include tax implications. Every year you see this thing they do, audited accounts, where management accounts are brought together, analyzed, and decisions are reviewed, and an opinion is given by the auditors on the status, the health status of your organization. Another thing they do is that they compute the tax of the organization while also doing the profit and loss of the organization. While doing this, certain spends are categorized as investments. Capital expenses often go into these categories. Investment, because you don't use them up in 1 year. They provide utility for subsequent years. The percentage of it that is used for this year's production, entered in your accounting system as amortization or depreciation, is the one that is taxed. So organizations would like to keep their tax burden low by investing in capital assets investment. When they do that, when that's the position of your organization, you will definitely be recommending more of buy, not the lease or the utility as a service option. Then you consider the cash position. Organizations that have little cash, probably leveraging for all their cash spend. Leveraging simply means borrowing, taking advantage of one asset or the other to collateralize and take loans to run the business. Now, for such organization, why you probably think, okay, we should always buy our own assets because we can leverage them to get funds to deal with our operations. Don't also forget that there are interests that comes with loans, right? And that can be a big issue. If you take out the cash you have to go and pay someone else, and you now have liquidity issues in addition to the loans and the interest that you have to deal with, you might be squeezing your organization really deep. So if you don't have deep pockets, you don't have that surplus cash, you will not be buying. You will be leasing, taking that option. So think about that, FMs. Do you know your organization's cash position? Do you know how liquid you are? Organization can be profitable, but not liquid, which means on the books, it shows that we made a lot of profit or we're making a lot of profit, but our money is not in our hands. Either we are being owed or we have put out all the money to pay out those we are owing as well. Okay. And then also think about the cost of alternative decisions. If I have $1 million in my hands, I can buy something, or I can use it, to invest back in my business. So why would I spend that money buying a power generator if I can get the option of renting a generator or getting power supplied to me that I'll spend $100,000 or $200,000 on, leaving me the extra $800,000 to deal with other expenses in the organization. So FM should think about this when acquiring assets. A closely related financial concept to consider is the concept of best value, which extends the conventional wisdom pairing value and money, and instead implies a need to continually strive for something superior at the lowest practicable cost. All right, value is about the relationship of cost or price and quality of performance. Ideally, cost and quality should both be the considerations when FM decisions are being made, but cost should take sole priority only when financial constraints are severe and dictate so. Be that as may, we want you as FMs to always think about best value in terms of specifications, precise specification at the lowest practicable cost. Best value is your precise specification at the lowest practicable cost. What it means is carefully define in as much detail as possible exactly what you need from this asset, from this initiative, from this investment you want to do. Once you've specified all of that, you've prioritized those specification of features, according to which one is more important, and you go to the market, you go for the solution that provides you exactly what gives you the most important features and results you're looking for at the lowest practicable cost. That is best value. If somebody got something exactly what you have at a lower price, you have not provided best value, no matter how much you're enjoying what you got. All right, so the next concept of financial management for assets is deferred maintenance. Every time you see an asset dwindle in quality, start looking bad, start looking poor, start not looking up to standard anymore, there is deterioration that's taking place, because every asset you acquire, we talked about it in our previous sessions, they go through what we call the degradation curve. From the day it is bought, as its life is used from year to year, the quality, the aesthetics, the functionalities, all of those parameters that defines the quality or condition of the asset, they will be doing good, no matter how good your maintenance practices are, right? So the degradation curves normally sets in. Now, but when you see the quality decline, you can pick out what specifically is causing that decline, which we call defects or deficiencies, right? If you're able to fix a deficiency or a defect, the asset, goes back up in quality. So if you get an asset in place and you're able to fix every possible defect, whenever there's a scratch, you sand it out, you paint it back whenever there's a bearing dislocation, you put a new one, whenever there's a belt shifting out of position, making noise, overheating, you fix everything. The equipment tends to stay in shape, right? So your deferred maintenance is a listing of items, description of items you have not been able to do that gives you accountability for the dwindling condition of the asset you are managing. So in essence, I'm trying to keep it in top shape, but it is dwindling, which means there are some things I'm unable to do. Maybe, is it the money I didn't have? Is it the workload, the work scope was too small to call in a project for it? Is it, whatever it is that make me unable to do that thing that will bring it back to its perfect shape. Therefore, I'm seeing deterioration in its quality and condition. I need to be able to account for all of those in a deferred maintenance log that carries not just the item, the asset item, the description of the defects, the description of the solution or the scope of work that needs to be done, the prioritization for that, what level priority level I assign to it, how much it's going to cost. I must scope it as well, and then I must include a reason why it is deferred, why it's not been done, right? If that list gets longer, my assets quality or condition is dwindling further. If I fix things and bring that list a very short list or few or no items on the list, my equipment or asset have been elevated to a higher quality or condition, right? So I use my deferred maintenance tracking mechanism to follow through on how my equipment, my assets, my facilities is being run, is being invested in, is providing value. Okay. Now, what comes out of this is what we call the facility condition index. So as I'm doing the condition assessments, which is the project I used to get the first set of defects, tracking the repairs and restoration, and then continually do inspections to pick more defects or deficiencies and add to this list as I fix them. The list shortens as I add more things that are not fixed with reasons and cost and scope of work. The list become longer and my assets become more deteriorated. I'm keeping track of facility condition index. The FCI is a tool for comparing conditions of facilities, any kind of facility. It doesn't have to be similar facilities. I can compare a banking headquarters with an airport using an FCI, right? Because it provides an index, an indicator of the condition. What is the formula? Your deferred maintenance, all of those things I've just talked about, the cost of those things I've not been able to do to restore my asset back to full functionality or to its pristine state, plus the capital renewal, all the upgrades that are due. The difference between deferred maintenance and capital renewal or upgrades is that without upgrades, the equipment or asset can still be running. Okay, some things can become obsolete, some things can become, out of date, public perception and so on and so forth, but they are still functional. And I want to, change them, switch them out, to boost the image or other feature of my asset. So I need to do that upgrade or capital renewal on it, right? So if I take these two together, I'll say, okay, repair costs, whether it's deferred maintenance to bring back functionality or capital renewal to upgrade and uplift an asset, that's all together making my repair cost divided by my replacement cost, my current replacement value. If I were to fix how much, I put it up on that numerator. If I were to scrap and buy a new one, how much. I put it down in the CROV in the denominator, and that gives me my index. This index can be expressed in percentage, in ratio, or in decimal, right? And we say if the asset is in good shape, you have less than 5% of its cost of replacement as the amount you need to spend on it. And all the way to 30% and 60%, it tells you the condition of the asset. So track your FCI. The next financial concept I want you to learn is the 70-30 principle. This is what we call the proactivity principle in asset management. Okay, so even though we have 3 strategies for managing your assets, the run to failure, the preventive, and the predictive, they all can be proactive. Okay, so you can actually designate an asset for reactive or run to failure and still practice run to failure using a proactive mindset, which means you estimate the failure opportunities for failure using failure modes analysis. You budget for reactive repairs. You don't say it's an act of God. We didn't think it was going to go bad, and so on and so forth, so that you are ready for it when it breaks, even though you deliberately set up that strategy as let it break before I fix. It's not let it break before I find the money to fix it, or let it break before I know what to do to fix it. I have to have a plan in place for fixing it and returning it back to use even before it breaks. So that's why we call it a proactive principle. So no matter what asset management strategy you deploy for any particular asset, you can use the proactive principle. And what it simply says is, let at least 70% of your activities be planned and 10% be, spontaneous, or things that you did not anticipate. We say this is standard, but ideal, this you can get to an idealistic situation, you should be 100% proactive. Because there's no real ideal situation, we say let's operate on a standard of 70-30. Okay, so what are budgets? Budget is a formal expression, numerical expression of how the organization will expect to operate for a defined period of time. It helps to improve communication and coordination, forces you to plan with your team, provides a basis for performance evaluation, allows for fine-tuning the strategic plan, because you create projects to enact strategic plan initiatives. That's what budgets basically do. And then it helps you show to the organization that you are supporting the organization's mission and core business, that you're able to control costs, because all the due diligence you do during budgeting helps you contribute to cost control. Okay, it helps you to analyze, planned, anticipated, and even unanticipated cost increases or decreases for the period you're budgeting, and helps you to quantify the impact of any capital requirements on the operating budget. So if you have an investment in a brand new generator, your cost of oils and maintenance and spares for maintaining generators will definitely be affected by that investment in a brand new generator, at the same time in the future. Budget approaches could be authoritative, participative, or combined. Authoritative budgets is where you have management, senior management, deciding most things about the budget, how much you can spend, what are the goals to be achieved, and so on. And then giving you that to say, go and detail it, go and plan how you're going to implement it. In participative budget, managers at all levels participate. So we call this a bottom-up approach, where you work from first principles and develop your budget line items and bring it up to get approval. You have the combined budget that combines both approaches. It's both participative and authoritative, right? So we call it an iterative budget strategy. Two-way communication. Management already knows what can be spent and what cannot be spent. Work with you to determine the goals for facility, strategy goals, and projects that need to be implemented. And then you work your way up, basically redistributing the cost that has been approved into your plan and getting management approval. What methods can you deploy in developing your budget? Could be incremental. We call this historical budget, which means you take the line items and the cost of previous budgets and expenses, and you tweak it to what you're trying to do. The zero-based one ignores previous expense categories or budget categories in terms of the amounts, but leaves the line item. So you still have the line items, and you are justifying or removing line items before you go into quantifying what was spent into it. In activity-based, you don't have any reference to any past budget without line items or costs or expenses. You are looking at now in the plain sheet and saying, what are we going to achieve? How do we want to achieve it? What cost is going to go into it? What time we're going to do it? And this activity-based budget is the typical kind of budget you create when you are starting out a new operations, a new venture, a new company, whatever. You have to start from somewhere, developing a budget that is activity-based, because you're looking at all the activities that will give value to your end results. There are two primary types of budgets, the operating budget and the capital budget. The operating budget is the one that has a short focus, 1 year, typically, looks at your revenue, expenses, looks at all of the day-to-day running and routine activities that you spend on. And then you have the capital budget. This is where you spend money on projects, mandates from management. You look at your master plan, the different types of phases of investment that needs to take place. You look at the life cycle plans, capital plans for all of your assets, and you're seeing the ones that will be due for replacement at certain times, and you're bringing them up for inclusion in the CapEx budget. And these particular budgets, whatever you do with the CapEx budget will provide utility for more than 1 year, whereas whatever you do with the operations budget will provide utility for 1 year or less. Okay, so that's a brief discussion on asset financial management. I know some of you might have questions, so here's the time for the questions. If you are not on the facility management group right now, please join. It's on WhatsApp. The group right now has approximately 531 members, and we put opportunities out there for training, employment, conferences, vacancies, whatever it is that will add value to the careers of facility managers. Okay, so come in there right now. I would ask the team, please put the WhatsApp link in all our platform again now while we are here, so that each person that is live with us can join the WhatsApp group right now, and we'll be able to keep the conversation going. If you do have questions, feel free to ask the question on the WhatsApp group if you are there already. If you are not there right now and you have not joined the WhatsApp group yet, you can ask your question on our Telegram, Facebook, LinkedIn, Instagram pages where we are live at the same time in these weekly sessions. Your questions will get to me, and I will answer them for you on the WhatsApp platform. Okay. The WhatsApp platform is called the Max-Migold Facility Management Training. Max-Migold Facility Management Training. Okay, so in preparation for our January FM Diploma program starting in January, visit promo.facilitymanagementcourses.com, promo.facilitymanagementcourses.com, and read through fantastic program that has changed lives. The Alumni Association of the alumni, the FM Diploma, they were having a celebration, a reunion, an exciting time for people who have gained so much and up the game in their careers, to meet and reconnect and refresh sometime in November. And we have a graduation ceremony for all those who are graduating from the program in the month in December for 2023 graduation. So look out for those exciting events. There are opportunities for you to learn more about the FM profession and learn more about the opportunities for growth in career and business when you take the facility management diploma. So it's a big deal what we have lined up for you this month. So we have a free training, we have the alumni reunion, we have the graduation ceremony, three massive events scheduled between now and the end of the year. So don't miss out any of this. If you're not yet following us on all of our social media platforms, please do right now. If you're on YouTube, just follow and the page, like the page, and subscribe to our channel. If you're on Facebook, do the same thing. LinkedIn, X, and Instagram. We are here to serve always. So thank you very much. I'm still be on the lookout for your questions, even when the session has ended. Okay. Have a good afternoon. Bye-bye.